Hi everybody, Sarah Rentschler, advisor and tax specialist at Timewise Financial, here to break down the tax-wise gifting strategies in the new tax landscape. So, with the passing of the Big Beautiful Bill last year, we get a lot of questions surrounding what that means for gifting strategies. So I thought I'd do a video and walk through what has changed and what you can do to harness the new rules, making the most of your giving. So let's start with the basics, the annual exclusion. For 2026, you can hand up to $19,000 to anyone you want, a child, grandchild, or a friend, with zero tax paperwork. If you're married, you can combine your forces and gift up to $38,000 per person, completely tax-free. So what if you want to gift more than $19,000? The good news is that under permanent provisions of the recent tax updates, you have a safety net. The lifetime exemption is now locked in at $15 million per individual. And if you're married, that's $30 million for the couple. So if you want to help a child buy a house and say give them $50,000 this year, you won't owe a penny in taxes today. You simply file a standard informational tax form and the extra amount gently chips away at that $15 million lifetime cushion. It's an impactful tool for helping your loved ones. Additionally, there are two very specific ways to support your family's future. So first, you can Superfund a 529 college savings plan. What that means is the IRS allows you to bundle 5 years of gifts into a single year. So for 2026, that means an individual can contribute up to $95,000 as a lump sum per beneficiary without incurring any gift tax consequences. And the second is called the direct pay rule. That has to do with directly paying a college tuition or medical bill directly to the institution, and it's completely tax-free. It doesn't even go towards the $19,000 annual exclusion. So I wanted to share my absolute favorite strategy next. It's called the Qualified Charitable Distribution, or QCD. If you're 70 and a half or older, you can transfer up to $111,000 per year directly from your traditional IRA to a qualified charitable organization. We recommend this consistently because it's impactful for everyone involved. For you, the money bypasses your bank account completely, meaning it isn't taxed as income. If you're 73 or older, it can satisfy your required minimum distribution without pushing you into a higher tax bracket or spiking your Medicare premiums. And for the charity, they get 100% of those pre-tax dollars immediately, allowing your generosity to do the absolute maximum amount of good. And finally, the new cash contribution deduction. So if you take the standard deduction, the new tax law lets you deduct up to $1,000 for single filers and $2,000 for couples in cash donations. The new law also places a 0.5% floor on charitable contribution deductions for those that itemize. The charitable deduction is allowed to the extent the contribution exceeds 0.5% of the taxpayer's adjusted gross income, or AGI. So although this new floor also applies to contributions to donor advised funds, or DAFs, and gifting appreciated stock to charity, these strategies can provide significant tax benefits. So I hope this provides some clarity as to the different ways you can gift in a tax-wise manner to the ones and the causes that you care about most. So gifting is all about legacy and love, but the details matter. Keep good records, talk to your family, and as always, if you have any questions or want to discuss how these new laws impact your financial plan, please reach out to our office. And if you know anyone who'd benefit from this information or our services, feel free to share this video. Thanks.